Hey everyone, welcome back to The Explainer. Today, we're doing something super interesting. We're running Nokia's financial data through an absolute gauntlet, a valuation gauntlet designed by some of history's greatest investors. We're looking at a truly fascinating inflection point here. You've got a legacy telecom giant pivoting hard into the AI supercycle. So let's actually figure out what that pivot is worth. Here's the game plan for today. First, a snapshot and the Buffett lens. Then, we'll check out the Peter Lynch lens, move on to the Benjamin Graham lens, build out a DCF valuation, look at a few other models, and finally, wrap it up with our synthesis and final recommendation. All right, part one. Let's get a snapshot of the company and view it right through the Warren Buffett lens. So before we unleash the guru frameworks, let's just set the stage real quick. We're analyzing Nokia, ticker NOK. Now, since our source materials don't give us a live, real-time ticker price to work with, we're explicitly assuming 5.16 euros as our proxy price. You might be wondering why that exact number? Well, that is exactly what NVIDIA paid per share for their billion-dollar strategic stake back in Q4 2025. That's our benchmark. Let's see if the value legends agree with NVIDIA's math. Now, if we're talking Warren Buffett, it always starts with the moat. Does Nokia actually have an enduring competitive advantage? A moat is, what protects a business from having its profits just chipped away by competitors over time. Buffett also wants to see consistent earnings, high return on equity, totally manageable debt, and honest management. And honestly, Nokia is kind of digging a brand new moat right in front of us. Just look at this, a massive 56.4% year-over-year growth in their optical networks reported in Q1 2026. That isn't a fluke. That's driven directly by hyperscaler demand for AI data center connectivity. That creates a really deep, specialized technological moat. Plus, Buffett would absolutely love their balance sheet. They're sitting on a fortress-like net cash position of 3.37 billion euros at the end of 2025, which actually bumped up to 3.8 billion by Q1 2026. Basically, they have the cash to weather any storm and still heavily invest in the future. But, price is what you pay, value is what you get, right? Buffett focuses on owner earnings to figure out intrinsic value. If we use Nokia's 2025 free cash flow, which was roughly 1.5 billion euros, as our proxy for owner earnings, apply a conservative 6% growth rate based on their own targets, and then demand his famously strict margin of safety, Buffett's intrinsic buy price sits right around 4 euros flat. So for him, the business quality is totally there, but he'd probably wait for a slight market dip before pulling the trigger.
Okay, let's pivot to section 2, the Peter Lynch lens.
So Peter Lynch, he famously loved putting companies into distinct categories to really figure out what he was buying. And Nokia, it's just this fascinating hybrid. On one side of the coin, you have their legacy mobile networks business acting as a classic slow grower, with revenues expected to edge down about 1% to 11.3 billion euros. But strapped directly to that slow grower is a literal fast grower, the optical networking division. That segment is projected to jump 31% year-on-year to 4 billion euros in 2026. It's almost like a tale of two companies inside a single ticker.
So, how does all this balance out on the Lynch checklist? The balance sheet. Totally rock solid, that's a yes. The PEG ratio, that's price to earnings relative to growth, sits around 1.27 based on their projected 14% overall network infrastructure growth. It's not like a deep bargain under 1.0, but it's pretty reasonable. Actually, the standout metric for Lynch here would be insider and smart money activity. NVIDIA taking that massive institutional buy-in at 5.16 a share, grabbing a 2.9% stake. That acts as the ultimate validation of Nokia's AI ran top.
So what's Lynch's final verdict? Well, based purely on current multiples and the drag of that slow, growing mobile division, he'd probably call the overall stock a hold. But he would actively encourage buying into the turnaround narrative. Nokia's new streamlined model, where they're separating network and mobile infrastructure in 2026, combined with their 6G positioning, that signals a management team that is aggressively trying to unlock hidden value.
Right, let's hit section 3, the Benjamin Graham lens.
Now, the father of value investing himself, Benjamin Graham, relies on a super strict defensive investor checklist, and surprisingly, Nokia just breezes right through it. Adequate size? Yep, nearly 19.9 billion euros in 2025 sales. Strong financials? Absolutely, with 3.37 billion in net cash, meaning current assets crush current liabilities without any dangerous debt. Earnings stability? They're consistently profitable. And crucially for Graham, they have an uninterrupted dividend record, floating a proposed 14 cents per share for the year. And here's where the math gets really fun. If we plug the numbers into Graham's famous intrinsic value formula, which is the square root of 22.5 times earnings per share times book value per share, we land at a hard, mathematically derived intrinsic value of 4.89 euros.
This is using their 2025 diluted EPS of 29 cents and an assumed book value of roughly 3.67 euros. Notice how tantalizingly close that 4.89 is to our 5.16 euro proxy price? Graham would look at this and see it as fairly valued, sure, but it's just missing his strict 30% margin of safety.
Okay, section 4. Let's build out a modern discounted cash flow, or DCF, valuation.
So, as you probably know, a DCS is all about forecasting future free cash flows and discounting them back to today's value. We're starting with a very solid, proven baseline here, the 1.5 billion euros in free cash flow they generated in 2025. From there, we project out over the next 5 years using a conservative 6% growth rate. Why 6%? Because it aligns perfectly with Nokia's own stated long-term targets for their network infrastructure division. It's aggressive, yeah, but highly realistic given this massive optical network boom.
But of course, any DCF is incredibly sensitive to the discount rate, the WACC, and the terminal growth rate. If we assume a 9% WACC, which is pretty standard for a mature but evolving tech stock, and a perpetual terminal growth rate of 2%, our base case takes shape. The DCF fair value range centers right around 4.42 euros per share. So once again, we're seeing this really solid floor of value emerging in the mid-€4 range.
Section 5. Let's run a couple alternative valuation models just to be entirely thorough.
First up, comparable relative valuation. If we take their 2025 comparable diluted EPS of 29 cents against our 5.16 proxy price, Nokia is trading at an implied PE of around 17.8 times. When you stack that up against typical telecom and networking peers, it suggests the stock is fairly valued right now. Basically, the market is already pricing in the expensive transition out of legacy 5G spending and into this high-growth AI data center infrastructure. On the flip side, what if we look at Nokia strictly as an income-generating asset using a dividend discount model? Well, the picture changes entirely. Using that proposed 14-cent dividend, an assumed 9% cost of equity, and a super conservative 2% long-term dividend growth rate, the implied standalone value is only about 2 euros. The takeaway here? Nokia is definitely not a pure yield play. The true value of this stock lies almost entirely in its future growth and its tech pivot, not just in its current cash payouts. Finally, Section 6, synthesis and our final recommendation. Let's see if Nokia survived the gauntlet. Let's bring it all together. Looking at our master scorecard here, a really fascinating consensus starts to emerge. Buffett's model gave us 4.00. Graham's hard asset formula points to 4.89. Our modern DCF landed at 4.42, and the dividend model sits way down at 2.00. You see the trend, right? Every single quantitative value model suggests an intrinsic value slightly or moderately below our benchmark proxy price, the 5.16 euros that NVIDIA actually paid. So, putting on my expert investment analyst hat and relying strictly on these frameworks, our final recommendation has to be a confident hold at current levels. The fundamentals are undeniably strong. You've got a fortress balance sheet, a visionary CEO, and that staggering 56% growth in AI-driven optical networks. It's a great business. But a true value investor absolutely demands a margin of safety. To satisfy a Buffett or a Graham, you'd really want to wait for some macroeconomic volatility to cause a pullback into the mid-€40 range before deploying serious capital. But I do want to leave you with one final, kind of provocative thought before we wrap up. Our quantitative models all agree that 5.16 is slightly too expensive. Yet the visionary architects of this whole AI supercycle over at NVIDIA happily paid exactly 5.16 for a massive stake just months ago. So ask yourself, when a true paradigm shift like AI is happening, are strict value investors risking missing out on the greatest tech shift of the decade, all because they're stubbornly waiting for a 20-cent discount? It is the ultimate battle between traditional value and future vision. Thanks so much for joining me on this explainer, and as always, keep your eyes on the data.